The way I calculate it, we're just about at the time where Bitcoin's about to launch. So, in spite of all the, a lot of people out there are kind of going, gosh, this Bitcoin thing's not really working. There's a lot of inflation, they're printing money, gold's working great. Why isn't our stuff working? And I'm like, yeah, we've seen this before. Just relax, it's going to work. And when it does work, you're going to be really happy that you have it, because I don't think it's going to 126. I think it's going to 200 or 300 or 400. So, and at that time, gold will probably take a breather. I mean, don't get me wrong, in 5 years, I think, Bitcoin could be at 500 and gold will be at 10,000, but that's 5 years out.
A critical turning point in Lepard's thesis occurs with the collapse of political optimism around fiscal restraint. Early in the year, markets were hopeful that new leadership, budget tightening, and deficit control would stabilize government finances. That optimism faded quickly. The failure of meaningful spending restraint, combined with political maneuvering that pushed through another large spending package, made it clear that structural deficits were not going away, even in a healthy economy where deficits should be shrinking. According to Lepard, this was the moment when investors collectively realized that monetary debasement was not a temporary problem, but a permanent feature of the system. Gold responded decisively. After trading around the mid-$2,000 earlier in the year, it surged dramatically, signaling a renewed precious metals bull market.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
You and I know Bitcoin, a lot of people know Bitcoin, but the whole world doesn't really know Bitcoin. And people like in China and India, most places, they really don't believe in Bitcoin at all. And yet they understand what gold is. It's been around 5,000 years. So, and they understand that it protects you against monetary inflation. It always has, it always will to a degree. And so what's happened really is, I think as this inflation has become more obvious, and it happened this year, when Doge failed, in the beginning of the year, there was all this happiness that, okay, Trump's elected, we're going to have Doge, we're going to cut back, we're going to balance the budget, everything's going to be good. But you know what? Doge failed. And when Doge failed, and the big, beautiful, and we had this Liberty Caucus in Congress that was going to tighten up and balance the budget and all this stuff, and Trump steamrolled him. And so the big, beautiful bill came through, and yeah, we got some tariff income. That's a positive, that's a net positive. But the big, beautiful bill pretty much wiped all that out. And so, we ran a flat year-over-year deficit, and I would argue it was actually a little higher. They did some legerdemain to make the numbers cook the numbers a bit, but we ran a flat year-over-year deficit in a healthy economy where the deficit should be getting smaller. And so, I think at that point in time, late this fall, what happened is a lot of people woke up and said, this monetary debasement is just going to continue forever. This government is out of control. They embrace Lynn's meme that nothing will stop this spending train. And so gold, which was in the 2,500 range at the end of September or August, early September, just finally said, okay, I get it. And it shot up to 4,400 really quickly. And now silver has followed suit, which tells you we're in a real precious metals bull market. Bitcoin, sadly, has not gotten it. And Bitcoin actually is much more, so gold is reflective of monetary debasement, always has been, always will be. Bitcoin's a little bit reflective of monetary debasement, but that's only the real hardcore maxis that get that piece of it. The rest of the market tends to look at it a little more like a trading widget and a little bit more liquidity driven. And so, it tends to lag gold on this monetary debasement thing. And it did, in the last couple of cycles, and it's doing it again. And so, I've kind of said, and others have mimicked me on this on Twitter and said, gold leads, but Bitcoin follows harder. And so if you look back to 2020, it's a very good example. And I like this example a lot because, when COVID came around, go back, scroll over to your 2020 thing where you can see the dip. Yeah, you can see the dip in early 2020. That was, look at a March, and gold went down substantially. And then they announced they were going to print like crazy. And gold took off like a scalded dog. And it went from 1,500 to over 2,000 really quick. Okay, and that was the early part of 2019. But, Bitcoin ultimately did that, but there was a lag. It didn't do it on the exact same time frame. It did it with a lag. And so I think that's just what's going on right now. Gold has already taken off, and it's about to hand the baton to Bitcoin. And by the way, this chart, the scales on this chart are different. It's important to point out that on this chart, gold's gone from 1,200 to 2,000 in that time frame. In the same time frame, Bitcoin went from 10,000 to 60,000. So, gold went up 2x and Bitcoin went up 6x. So that's why I say Bitcoin follows harder. And, as the chart you showed a moment ago, the one that you and David built, I mean, tends to be, it seems like on average, about a 100-day lag. Mm-hmm. And so, it would seem to me that, the way I calculate it, we're just about at the time where Bitcoin's about to launch. So, in spite of all the, a lot of people out there are kind of going, gosh, this Bitcoin thing is not really working. There's a lot of inflation, they're printing money, gold's working great. Why isn't our stuff working? And I'm like, yeah, we've seen this before. Just relax, it's going to work. And when it does work, you're going to be really happy that you have it, because I don't think it's going to 126. I think it's going to 200 or 300 or 400. So, and at that time, gold will probably take a breather. I mean, don't get me wrong, in 5 years, I think, Bitcoin could be at 500 and gold will be at 10,000, but that's 5 years out. I think the 4-year cycle got originally built around the halving thesis and the way that the mining reward went down, by half every 4 years. And that clearly, drove the supply side of the equation in the earlier years. I think we're now at the stage where the amount being mined relative to the amount outstanding is small enough that that's not really an important variable in driving the Bitcoin price. And so I kind of think the 4-year cycle is dead. And I don't think we peaked in the last one. I don't think we hit a mania phase. And I think that, it's gotten extended. Now, there will still be cycles. I think the cycle tends to be driven a little bit more off of just how much leverage is there in the system. And, at some point in time, Bitcoin's going to take out that 126 and really start to trend heavily towards 170 or 180. And let's face it, we're a nation of gamblers, and the world is a group or a bunch of gamblers, and they're going to be people who go in there and buy Bitcoin on leverage, and they're going to shove it to 300 or 400, but then we're going to get a 50% correction off of that. And the last person who buys it at 400 and watches it correct to 200 is going to feel like shit. But, all those of us who own it at 90 are still going to be okay at 200, and maybe at 400, some people will peel a little off. Maybe they won't. I doubt I will. But, my view is I might slow down my buying at that stage. I mean, I always, when I'm out there looking, when I have new cash that I earn, I kind of ask myself, where do I want to put it? And I always kind of look at what's relatively cheap. And, a couple of years ago, gold was kind of relatively cheap compared to Bitcoin. I mean, now I really think Bitcoin is very relatively cheap compared to gold. And I haven't mentioned this in a tweet a while back. I was actually selling some gold items to buy Bitcoin items. I bought some more MicroStrategy. And part of that's because I've got gold stocks that are up 4x. And they're good stocks, they're good companies. I think they'll go up higher in the next couple of years. But whenever you see a 4x move in a year and a half, it's wise to maybe take a little off the table and rotate it into something that's cheap on a relative scale. And gold compared to Bitcoin, or Bitcoin compared to gold right now, is very relatively cheap.
At the heart of Lepard's thesis is an unflinching critique of the Federal Reserve. He argues that the Fed cannot escape the mathematical reality of debt-based systems. You cannot grow debt faster than the money supply indefinitely. Quantitative tightening was always temporary. As debt servicing costs rise and liquidity tightens, something breaks. Repo markets, credit markets, or asset prices. The Fed is then forced to pivot. Lepard frames the current environment as the beginning of another printing cycle. Rebranded as reserve management, but functionally indistinguishable from quantitative easing. While the pace may be slower initially, he believes this is merely the opening phase of a much larger expansion. Importantly, the Fed is easing despite inflation still running above target and asset prices near record highs.
And by the way, I don't think that top at 40 is locked in stone. I mean, I think the next top, we're gonna go define a new range where the next top is going to be between 60 and 90. So, because I do think that over time, Bitcoin is just going to continue to demonetize gold. There was a good chart on Twitter I saw a day or so ago that showed the growth in addresses. It just is relentless. The only thing that could stop Bitcoin is if everyone kind of decides I'm not going to use this anymore, and yet there's just no evidence of that. I mean, Harvard University just tripled their allocation. I mean, they're not stupid. You're seeing just all kinds of new buyers.
It's now the largest single asset in their fund.
Yeah, exactly. And so there are, and there are just other instances of it. I mean, I think the Luxembourg Sovereign Wealth Fund took a position. I think the Czech Central Bank took a position. It was trivial, it was small. But the point is that, you're just seeing more and more of this adoption. And that's why, there's a pretty good bid underneath it right now. I mean, I know some people have sold it here thinking it's going to 60. And in a risk-off environment, COVID-like, where everything correlates to 1 and everyone sells everything because they're getting margin called, could it go to 60 briefly? Yeah, possibly. And then the Fed would come in with the fire hoses because the world's going to end, and it would come out of that hole and it would, shoot up to 200 very, very quickly. I mean, this really is no way to manage a railroad. The Fed is they're just out of control. And I tweeted about that recently. I mean, we go from interest rates of 7% to interest rates of 0, back and forth, back and forth. And in the 80s, interest rates as high as 20%. I mean, it's nuts. I mean, it's just, you can't have a committee of 12 people setting the price of money and expect it to work. I mean, that's a stupid notion,
Yeah.
But that's what we got. So let's not kid ourselves. It is money printing in the sense that the Fed is using newly created dollars created with a keystroke in order to buy treasury bills. They're not buying duration. So as a result of that, they're claiming that it's not QE per se. It's kind of a semantic, distinction without a difference, because it really is very similar to QE. They are increasing their balance sheet and increasing the stock of money in the system. And I would say, one, it's interesting because until recently they were letting their balance sheet run off and they were tightening, so they were in a quantitative tightening regime. They signaled they were going to stop that, and we knew that was kind of coming. What we didn't know is that they were going to pivot and actually go to a printing operation, which they've done, and they've rebranded it. Instead of calling it QE, they're calling it reserve management, and it's because the plumbing is tight. Those of us who are in the Bitcoin world and all the people looking at the monetary system understand is that you cannot continue to grow debt without growing the underlying money supply, or else you don't have enough money to service the debt. And so we always knew that Powell's attempt to be Paul Volcker, while it brought inflation down a bit and caused M2 to go negative for a little while, M2 growth to go negative for a little while, we knew that it couldn't last forever. And the reason is just mathematics. I mean, again, if you do not grow the money supply, how do you pay the interest on the debt? So, they realized they were getting to a point at which, historically, this has caused trouble. In 2019, we saw the repo blowout, which led to what I'm actually calling this the second Powell pivot, because the first Powell pivot is they were tightening in 2019, and then we had a repo blowout and spike, and that was based on the reserves in the monetary system getting too low, and that led to a reversal of tightening and quantitative easing, and then of course not long thereafter the COVID hit, and then we got what truly was the second of the big prints, the first being in 2008. And it's interesting, this one, Lynn and I have had friendly banter back and forth on Twitter. She's calling it the gradual print, and she's right. I mean, 40 billion a month, 480 billion a year is not multiple trillions within a short window. Although I think the original big print, the one in 2008, probably started off about this size, and they ramped it up over time. They went from 800 to 3 trillion on the Fed balance sheet, but it took them 2 or 3 years to do that. The second one, the COVID one, was much more aggressive. And they went from 3 some odd trillion on the balance sheet to 9 trillion at its peak. It's come back down to 6, into the 6s now, but and that was a much more aggressive big print. And she's right, we really are kind of gradually printing. It's just a shift in the tides from tightening to printing. What I'm believing or suggesting is that I think this is just the beginning, and it's very likely that this will be adjusted upward as time goes by, because my sense is, and it's interesting, they originally, when they floated this idea, Bank of America and a few others kind of floated this idea as a trial balloon a week ago or so, and they suggested that maybe it would be 20 or 25, and then they actually came out with 40, and they said, but maybe they'll cut it back over time, and they said that 40 because they wanted to get ahead of it. Now, let's not make any mistakes. There's no way they would have done this if they didn't have to. They did not want to do this. They want to be good monetary stewards. They want to get inflation under control. It's not, here they are, changing from monetary tightening to monetary easing in an environment where inflation is well above their target. It's running 3% when their target's 2%. And when the stock market's at a record high, and when employment is, while a little bit soft, it's still generally speaking healthy. So if they're printing money in an economy that's more or less doing okay, imagine what happens if any of those other conditions change. Employment gets worse, the stock market goes down, the leverage starts to really bite. That's how I think we go from Lynn's gradual print to Larry's big print. So I kind of think that's where we're going, but one step at a time. I mean, to me, I was a little shocked actually when I saw the press release yesterday. I thought, well, they'll hold off as long as they can. Even though it had been floated in trial balloons, I thought, well, it probably won't start till next year, but here they are and they're doing it. And not only that, but they decided to start it today, the 12th. I mean, the press release was 2 days ago. So it must have been fairly, pressing in their mind that they had to do this, because they announced it on the 10th and they started on the 12th. So here we are. There really is. And it's sad because, everyone knows, anyone who's studied history knows that socialism just does not work. It's a failed model. It's a step before communism. That really doesn't work. And, sadly though, you look at a Mandami and he's a good politician, right? I mean, he knows how to tell people what they want to hear, and they are hurting and they understand that, and they feel like he understands them. And, they buy into his notion that something for nothing is available. And that's a seductive notion. I mean, the sad part is it's just not true, but it is seductive. And so, some segment of our citizens are going to have to learn that lesson the hard way. And hopefully enough citizens understand that's a broken lesson, but a broken model. And we'll see what happens. I mean, I think that, if what I'm describing occurs, things are going to get worse. Inflation is going to get higher. And, heaven forbid, but, blue team could win 2026, probably not. But 2028, very possibly, not because, they've got better ideas, their ideas are wrong and broken, but more because, when things are hurting, when people are hurting, there tends to be a natural tendency to throw the bums out. And, okay, let's say it's now 2028, the next presidential election. Let's say inflation's really ravaging people. It's been terrible for quite some time. Somebody and the Democrats will come in and they'll claim they can fix it. They can't. And they'll have a lot of cockamamie ideas that won't work. But they'll sound good, and they'll talk about stimmy checks and all the other things that they can hand out. And, some portion of the uneducated populace is going to go, yep, I want that. Sign me up for that. Throw these bastards out. I hate the inflation. And so they'll get the new team in, and the new team, by the way, will probably be much, much worse. They'll do universal basic income. They'll forgive student debt. They'll run it incredibly hot. And at that point in time, my model is that the currency system fails, that we really do have, South American like super high rates of inflation, arguably bordering on hyperinflation. And we're really forced to do a monetary reset. And so I think that's where we're going. And I've said in past speeches, or past talks about this, I think, the person who does that monetary reset is President Saylor, because I think President Saylor gets elected in 2032 after the Democrats have completely effed it up for 4 years. And he has the receipts, understands the history, explains the solution, and everyone's so disgusted and tired of being broke and having the system be broken that they listen to him, and we return to a sound money standard. So, that's my idealistic and hopeful outcome of it all. But the sad part of that is that we've got some years between here and there when that, for that to occur.
Lepard extends his analysis into politics. Inflation erodes trust, fuels populism, and drives voters toward promises of easy solutions. These promises, stimulus, debt forgiveness, universal basic income, only accelerate monetary debasement. He outlines a bleak but historically grounded scenario: worsening inflation, political turnover, escalating spending, and ultimately a currency crisis that forces a monetary reset. This is not a partisan argument in his view, but a structural one. Despite the severity of his outlook, Lepard ends on a note of cautious optimism. He believes monetary collapse eventually forces reform. Sound money systems reemerge when fiat systems fail. In his most aspirational vision, this culminates in a return to monetary discipline, potentially anchored by Bitcoin or a Bitcoin-backed standard.